Hello, everyone. Welcome to the 5 Minute Show. This is a show where I try to explain an emerging trend or emerging economic thing happening in 5 minutes or less. Today, I want to talk about the US consumer. You see, the headline will tell you everything is fine, but the data is becoming very clear. The US consumer is cracking. You know, you can spin the narrative, blame politics or whatever, but when you look at the numbers and when you look at the leading indicators, they are flashing red signs. And make no mistake, consumers in the US are one of the biggest powerhouses. If they pull back on spending, it impacts the entire economy. And for investors, it means that, you have some opportunities and some risks to look out for. Before going to any details, know that there is a reason why, after financial crisis, President Obama announced the Cash for Clunkers program. There is a reason why, during the pandemic, President Trump and President Biden handed out massive amount of money to consumers. In fact, look back at any previous economic slowdown in the U.S. economy, you'll notice that U.S. government and Federal Reserve had their eyes on what consumers were doing and how they were acting. You see, when Americans have money in hand and feeling rosy, they actually go out and shop, and this translates into businesses selling more, producing more, hiring more, and the economic cycle goes on. But on the other hand, once consumers stop spending or pull back a little bit, you get, decline in sales, businesses start to laying off employees, and things get worse from there. Now, coming back to what's happening to the US consumer right now. As it stands, it looks like US consumer is cracking, but I don't think it's a deep, sort of a collapse situation, but it's starting to look like people are watching their pockets no matter which income bracket they're on. And their sentiment isn't as rosy. And to me, this is enough to, put that skeptical hat on and pay close attention. First, let's look at the consumer sentiment. And one of the most quoted, consumer sentiment indicator is the University of Michigan Consumer Sentiment Index. It essentially asked, Americans how they're feeling about their finances, economy, and buying. And the thing is, it continues to decline. And remember this, a pessimistic consumer doesn't, go out and buys that cool gadget, the bigger house, and, all those things. If you look at corporate America, they are really warning about what's happening with the American consumer. Take a look at Dollar General, for example. Recently, they said that high income earners are becoming their customers, and this trend is accelerating. Then you have Dollar Tree that said high income earners are their fastest growing customer group. If you look at those casual restaurants like Chipotle, Cava, Sweet Green, they're reporting that people aged between 25 and 35 aren't visiting their restaurants often, and all of these three food casual dining stores have lowered their forecasts. But that's really not all. The list of companies reporting that Americans are watching their pockets is growing by days. Recently, we had Home Depot, Target, and I'm pretty sure more will follow. Then take a look at subprime car loan borrowers. In September, subprime auto loan defaults hit a record high. According to data from Fitch Ratings, in subprime auto loans, at least 60 days past due surged 6.65%. This is the highest since 1990s when the firm started to track this data. I can't stress this enough. This is not one demographic issue. It's an overall thing and it's very dangerous. Right now, we're told consumer is resilient and there aren't many problems. And in to defend this position, you'll hear all about like how the New York real estate is hot, or you'll be pointed to lower unemployment numbers. But it is becoming clear and clear every day that average Americans are feeling the pressure. And with that, one has to wonder, are they on cusp of cutting back more on their spending? If Americans become more pessimistic and start cutting on spending further, you got to watch out. Once again, if consumers struggle, the US economy follows. And now you might be wondering, where's the opportunity or the risk? The simple thesis would be to be caution around consumer discretionary. If consumers aren't doing well, it's not a wild idea to think that they won't go out and aggressively buy things they want. Consumer discretionary stocks have seen a massive run up since 2020 lows, but since late 2024, their performance hasn't been that great. If you look at the XLY, which tracks the consumer discretionary companies, yes, these stocks have recovered a little bit from April 2025 sell-off, but haven't done much since mid-September of this year. And as I record this, XLY is actually down around 8% from its 2025 highs. This hints that investors are already feeling uneasy holding these companies. But that's one area to be careful. But think of it the other side as well. If you're worried about your job or finances, you don't stop buying your laundry detergent. On top of that, there's this constant noise about inflation. So I think, and I wonder, could consumer staple companies actually maintain their pricing powers and keep their financials stable? You know, Staples, tracked by XLP, have been range bound for a while, but recently there has been some life in them. I wonder if they're worth watching. Could money leave from discretionary and move towards staples? It might be possible. And lastly, you got to look at healthcare and utilities as well. These sectors tend to benefit as the economy slows and consumer prioritize their essentials. You pay your utility bills regardless of where you think the economy is going. If you need healthcare, you go to the hospital and you get yourself checked. That's it for today. I'll be back again. In the meantime, don't forget to like this video and subscribe to our channel. And remember, anything that I've talked about is not financial advice. Any stock that I've mentioned in this video is not a advice or a recommendation to buy or sell. Do your due diligence because you are the best money manager of your savings.